very much for being with us today. We have people from around the world, so it is very exciting. Also, please give us a few minutes, and to the people joining us, welcome to this webinar. We are currently live on YouTube. Thanks, Lou. And the recording of this conversation will be also available on our YouTube channel. We also have simultaneous translation in Spanish. You just need to click on the interpretation icon, a little globe at the bottom of your screen, and select the Spanish channel. We will be receiving questions throughout this webinar. Please access the chat box, send us your questions, and I will compile them and direct them to the panelists. Again, to the people joining us, welcome to this webinar. And para aquellos que se están uniendo a este webinar, bienvenidos. Tenemos traducción simultánea en español. Aquellos que quieran seguir el webinar en español, revisen la opción de interpretación en la parte inferior de la pantalla y seleccionen el idioma que deseen. Algunos van a tener una versión más actualizada en donde pueden hacer mute al audio original. Esta es una buena opción. Y por favor envíen sus preguntas, pueden ser en inglés, pueden ser en español, por el chat box o por el Q&A. I'm switching back to English. And I am Carolina Barreto, Program Manager of Latin America for Climate Bonds Initiative. We are a global organization working to mobilize capital for green solutions. And you might know us from the green bond market, but we are also supporting all types of financial instruments that allow us to fight against climate change. Today, we're going to talk about how to manage currency risks or foreign exchange, FX risks. You might hear these words in the next hour, so please get familiar with the term. So first of all, again, thank you to our panelists. And I want to thank TCX Fund for allowing us to host this webinar with a special focus on Latin America. I know you already did a very interesting webinar in ASEAN for the ASEAN region. Now it's our turn. TCX offers global solutions to manage currency risks in developing and frontier markets for local currencies. We have Jonathan Luini from Structuring and Sales talking about these opportunities today. We have with us Camila Ramos, Managing Director at CELA, a Clean Energy Latin America, and CEO of Absolar, Brazil's Solar Energy Association, a sector which is growing exponentially, but predominantly with domestic capital. Absolar and CELA have been long-standing strategic partners of Climate Bonds Initiative in Brazil. We also have Robert Voskulen. I hope I'm pronouncing your last name correctly. I did my homework yesterday. Robert is a senior investment officer specialized in renewable energy finance at FMO, the Dutch Development Bank. FMO, for those that are getting familiar with the topic, was behind the creation of TCX Fund, something we will cover later. And FMO is also an institution with a huge interest in frontier markets in Latin America. So again, for those that are joining us, thank you very much for your time and welcome to this webinar. before we start, I would like to give you some context on today's topic. So in the region, we have experienced an extraordinary interest in sustainable finance. More companies are exploring opportunities to issue green bonds or to refinance their debt. They are doing this by labeling projects with green credentials in order to get lower coupon rates on their bonds and lower interest rates from green loans. Some companies want to issue in hard currencies in Europe and in the US, or want to have access to loans from international financial institutions. So for local companies, this creates a mismatch in their cash flows. On one hand, their income is in local currency from the local operations. But on the other hand, their debt payments are in hard currency. So this mismatch creates a huge risk, especially in countries with high currency volatility, illiquid currencies, or long-term projects. Additionally, international investors are looking for yield, and many of them have already green mandates. So some of them would like to enter into the local markets, but the currency risk drives them away. So today, we would like to talk about solutions to manage currency risks to unlock the potential of green finance in Latin America. We will have the experience from the supply side with Absolar and Cela, and the demand side with FMO, the Dutch Development Bank. They will share their experiences with currency risks for renewable energy in Latin America. But before starting with them, let's start with Jonas from TCX to understand what FX hedging is. So Jonas, welcome to the webinar. Thank you very much again, and over to you.
Thank you very much, Carolina, and good morning, everybody. Let me try to put up my presentation first. Hopefully it's not going to be too much of a challenge. Yeah, and here we go. I hope everybody sees it.
Yes, perfect. Just if you...
Thank you.
That's fantastic.
So as I mentioned, well, my name is Jonas. I work in the structure and sales team of TCX. So the reason why I think we're organizing this webinar is because of the mission of TCX, that is providing like a hedging solution across the most challenging markets in terms of currency, in terms of derivatives, and to offer it to investors that wish to work and to invest in mostly in developing impact projects that could be in different sectors, obviously. Specifically also, this is a big application in green bond, where the market, I think it's definitely like expanding, and the interest, we have seen increased interest for our solution. So maybe we can start a little bit with the problem that we see as of TCX. We see many projects in several high impact sector that have naturally local currency revenues and local currency balance sheet. And however, they find it difficult to access local currency, especially with international investors. So what happens is that they end up like issuing US dollar denominated green bonds in this case, or in general, like dollar denominated debt instrument, at the same time then creating a mismatch in their balance sheet. So they take FX risk. Their local currency, they have local currency revenue, and they take dollar debt. Alternatively, they can think about, and that we are proposing here, to issue local currency bonds. However, they face a limited investor appetite. International investors, many cases, they don't know how to, they cannot manage FX risk. They don't want to take like these FX exposures to this emerging market currency. So they might decide to do not access, they do not purchase that bond or do not offer financing. The third option that many have explored, and that's probably very common, is that the issuer or the investee index his own revenue into US dollar. So they have local currency revenue, but they adjust them based on how the FX move. This way, they simply pass the FX risk down to their clients. This is done, for example, in the case of tariffs. You adjust the tariff based on the dollar local currency rate, and is the end client that that take any variation, any hit. This is obviously less than ideal. If I were a client, it would be like challenging to manage. But these are the solutions that the situation that we see in the market right now. This is where TCX come in. What we do is that we believe we provide like a solution to mitigate the FX risk and to allow essentially investor and investee to essentially do not have any residual FX risk in their operation by the fact that we absorb it. So let me start by saying a few words very quickly about TCX. So we're a fund. We've been created by governments and multilateral development banks that are our shareholder. And we've been created in 2007 to absorb frontier and emerging market currency risk. That's our mission. So what we do is that we offer FX derivatives to essentially shift the FX risk from investor and investee to us. It ends up in our balance sheet. And we manage it by the single solution that is diversification. We have multiple currency, and we keep them in our balance sheet. We try to manage that at the end of the day, we don't incur in any loss. So it's a centralized management of FX risk, obviously with a team that is expanding. And the key feature of TCX is that one, we offer the solution for markets that are not covered by commercial banks. If you take the example of Latin America, certain currencies are covered by commercial bank, Americans and local banks. However, sometimes they have a limitation in terms of maturity. They cannot go beyond 2 years, 5 years, 7 years, maybe 10 years, or they don't offer it at all. And we're going to go in a second, like to look a little bit more closely to what is offered in the market. And so we offer like our product like up to 55 years, but we can do even longer. Essentially, we don't have any maturity limitation for our products. And obviously, and finally, we have also like a mandate to develop capital markets. Our purpose is to help local capital market to develop by showing that there is a way to offer this product and how they can serve like local clients. Just a few figures very quickly. We have hedged like almost 8 billion in trades over the lifetime of the fund. I think we have a live book that is around 5 billion. We have quite a lot of capital because we are in a risky business. Taking that much FX risk is somewhat dangerous. And you can see that we can offer up to 110 currency. We have 56 that are currently traded. And obviously we have also like a rating for S&P that, that prove like the soundness of our fund. So the first thing I would like to explain very briefly is which are the products, because you've been hearing me talking about it. So we offer two very simple products. These are simple derivatives. It's nothing like complicated. So we offer FX forwards and cross-currency swaps. So these are products that allow to exchange essentially two cash flow. A dollar cash flow or a euro cash flow against like a local currency cash flow. These products they have a feature that is the non-deliverability. What does it mean? That we don't actually exchange with our clients the currency that we are using. We don't, for example, let me take an example of the Mexican pesos. We don't actually give Mexican peso to our client and they give us dollar, for the simple reason that it's very difficult to move currency cross-border. And yeah, it requires regulatory approval that it's difficult to get. So what we do is that we simply denominate cash flow in the two currency, and then we net settle the difference between the two legs at each repayment. So if a currency depreciate, we end up compensating the client. If the currency appreciates, it's the client that gives us the difference. As I mentioned before, like a TCF can offer quotes usually from a 2-year maturity up to 30, 40 years, 50 years. We don't have any limitation. And in terms of rates, this is important. We can offer like a fixed rate instrument where essentially the interest rate in the local currency is fixed for all the maturity. For example, like, I don't know, in Colombia, we can offer something with 8% interest rate, or we can offer based on a benchmark that could be like, if you take the case of Colombia, the IBR, IBR plus margin that is repriced periodically. And now on the available currency. So I think we have a complete currency coverage for Latin America, and we focus on countries that are less covered by the commercial banks. So you see some names like Suriname, Guyana, or Haiti, to a certain extent Bolivia and Paraguay, that commercial banks do not cover. They don't offer any products for hedging. And then you see like currencies that are more what we define as liquid, where there are multiple bank quoting, and you have Brazil and Mexico, Colombia and Peru, where our added value is more on the tenors. If a bank can offer up to 5, 6, 7 years, we focus more on maturity that are longer, and where like there are no real alternatives. This is very important to us to be additional to the market, additional to the solution that are available. We don't want to compete with banks. That's really not the purpose. And now I wanted to take you a little bit more like to look a little bit at the solution that we could suggest to the problems that I mentioned at the beginning of my presentation. So specifically for green bonds, we see that the market for local currency green bonds is still somewhat immature. The dollar is still predominant, but there is definitely some potential to expand it. In a few more development markets like Mexico, Brazil, and Colombia, we have seen local currency becoming more or prevalent, especially for debt instrument, because like there is either a regulation that favor it, or also like there is more of a consensus of a market. I think the market is simply more mature. The solution, like initially, is simply encouraging public and private issuer and the writer to consider to fund themselves in local currency directly, knowing that there are instruments to manage the FX risk efficiently that are available to investors. TCX trade with a number of investors, a number of counterparties. We can onboard new clients, obviously. We trade with the multilateral development bank, with private fund, with commercial banks. So we are open to offer our services to different type of counterparty. Obviously, the third level of to promote local currency green bonds is a policy making at country level that should promote the local currency. If we take, for example, the case of energy, every time there are like tenders, if those tenders would be directly in local currency, that would actively push and help the market to move toward that direction instead of dollars. Now I want to show you like very simply what the mechanics are of the solution that we're offering, that we're suggesting. If we take it in this case, like let's imagine an energy project. They're trying to find themselves through a bond issuance. And normally what you see at the top left of the graph, this bond issuer will be denominated in dollar. Instead, what it would be probably ideal if the issuer has needs for local currency is to simply offer like a bond in local currency with the that would attract like essentially investors that might not be able initially. I mean, normally they might not be interested in a local currency bond. However, if we structure a synthetic local bond where the cash flow are still denominated in local currency and dollar, but the funding is all channeled through dollar, that could be like a solution that is viable. What would it need to do the investor at the same time? He would purchase the bond, take a bond that is denominated in local currency, however, providing the equivalent in dollar to buy it. And at the same time, it would come to TCX to contract a cross-currency swap to exchange the cash flow. So essentially say to TCX, I'm going to receive this cash flow in local currency from the issuer. If we exchange it, I want to exchange it in dollar, therefore securing a fixed return in dollar to avoid any currency mismatch, any FX risk. This way, the investor end up like at the end of the day with a bond that is denominated in local currency, but it has a cross-currency swap, a hedging instrument to hedge the FX risk. This way, the FX risk move from left to right from the issuer, from the project, to the investor, and then to TCX that absorb it entirely. This is a way for essentially for the issuer to have a local currency liability and to do not to bear any FX risk. For the investor, this is the opportunity to expand the product that they can access to and do not focus only on US dollar denominated issuance. So the application, what can be hedged? Which sector and who can hedge? So the application in terms of what can be hedged is very wide. Actually, all debt instrument, bonds, green bonds and normal bonds, notes, loans, even deposits can be hedged. Everything essentially that has a fixed cash flow. Again, in terms of sector as well, it's pretty much very wide what can be in scope. So we have hedged energy deals, infrastructure deals, transport, construction, agriculture, telecom. So everything essentially that has an impact, although the word impact is a bit vague, but everything that favor like the development of a country and that has essentially a positive impact. We cannot ourselves hedge project, for example, in, I don't know, the gambling industry or coal mining or something like that. And then who can hedge? In the example that I gave you, it's the investor that purchased the local currency bond and providing a form of debt, and then hedges and secure a US dollar and euro return through the cross-currency swap. At the same time, is it possible to do the other way around? With an investee or an issuer receiving a hard currency debt or issuing a bond in dollar, and then itself like going into the market with TCX or with a bank and hedge this bond. This is a little bit more complicated and a little bit more difficult to manage sometimes. However, it is possible. And then like finally, I would like, before going into two examples and to give you an idea of what we have done already, let me give you some couple of advantages on that local currency had. Providing, the first thing is that as an investor, you provide the right type of funding to your client. Some business require local currency, often for long-term maturity, and they need it. Therefore, like giving them this the possibility to issue local currency and have like investor that buy this bond is super important. At the same time, you contribute actively to the local capital market development, because these are instruments that has that can be issued locally even, and they have a big they have a big impact to promote like a local currency instrument. And again, you expand your own outreach because you are buying local currency security and hedge them back to dollar, so you can access a wider number of instruments. From a point of view of the investee or the issuer, in the case of green bond, well, you have no currency mismatch between debt and revenues. There is no exposure, no risk, and you're protecting the viability of your company or your project. The cash flow are predictable in local currency, so there is no need to look at the FX volatility every day. And furthermore, you also improve like your better credit risk for vis-a-vis of lenders that look at the balance sheet and they look at less risk bear in the balance sheet of our company. And overall, also this has an impact for the whole sector, in the sense that the lower are the level of dollarization in a country, the less likely that there could be like shocks, macroeconomic shocks related to the effects that could affect different sector. So you are essentially breaking the destructive cycle of currency risk by focusing on local currency instead of dollar. And finally, let me give you like a very quickly two transactions that we have done in the past that give you a sense of what we have done. So the first one is we have provided the hedging for a $50 million US dollar loan for 9 years for a city in Argentina. I'm not going to tell you which one, that wishes to finance a new bus transport system. This has been done through one multilateral bank, essentially have provided like a debt, and they wish to do it in local currency, in Argentinian pesos. Yeah, that was like the requirement, and this was like essentially the municipality taking on debt, and they wish to do it in local currency to avoid any FX risk. Wisely so, given the case of Argentina. And in the second case, this is an investment bank that wishes to provide funding through essentially to an electric company in Costa Rica. Again, I'm not going to tell you which one, but you can figure out maybe which one. And they wish to do it in local currency, again, to avoid like the FX risk. And this was like a 10 million loan for 7 years. So you see like quite long maturities. This can be structured as a private debt, like loans, or it can be structured as bond issuance. It's pretty much like it boils down to the same, like from a perspective of hedging. And maybe with this, I will stop. I think I spoke already too much.
No, thank you, Jonas. I think, let me open my camera. No, I think this was very, very interesting. This was a presentation to help us all to be on the same page. I would like to highlight some points that you mentioned and that people are asking on the chat. So first, this is who can hedge or who can use TCX. So definitely investors, but also companies that issue bonds or that have all type of debt instruments with fixed income, basically. So this is something important to mention. Something else is the type of sectors. So this is not only for energy or for renewable energy. This is very broad, so you can use it in infrastructure, agriculture, transport, as Jonas was giving out the example. Something else he mentioned is all debt instruments, everything that has a fixed income. It could apply, and I think the mechanism was very important. Probably a little bit technical for some of you that are not familiar with these topics. But basically, when there is an investor purchasing a bond and the bond is in local currency, then basically they go to TCX and they have a cross-currency swap. So basically, the investor will secure the fixed return on the US dollar, so they won't have the exposure on the currency, on the local currency.
Correct. Essentially, they're just exchanging what they receive with the dollar to secure the return in dollar, and do not have to manage essentially they don't need a return in Colombian pesos. They want a dollar at the end of the day.
Exactly. So I think this is really important. There is a question here. Let me see if we can answer this together. In case of the sustainability linked bonds, the flexible terms such as the rates depend on KPIs achievements. Can we apply this to same to the cross currency contracts? Have you had those experiences, Jonas, or do you think this is possible?
I mean, I don't think it is possible to do it from initially, because you need to agree on a rate at the beginning. But if through the lifetime of the hedge and then the bond, you want to adjust the return, it is possible. It is a form of restructuring, and it is possible to adjust it, and depending on how the market had moved, you can end up like making a gain or a loss, because obviously like it's not like in dollar that you say, okay, today is 3, tomorrow for the next period is 5. But it is possible technically to adjust it, although like not the easiest thing to do. What we have, what some investors do, I mean, these are not like a situation where the rate is increased, but obviously they can have floating rates where rates is changing, but periodically, but it's not based on KPI. However, like as I mentioned, if an investor come and say, okay, for the next period, I want to lower the interest rate by 2%, we can adjust the other leg to adjust the return on that. It's possible.
Okay. So it is possible. It could be a little bit more complicated. It could be a little bit more costly, but it is definitely possible. The last question, who usually pays the margin for TCX, investors or investees?
I mean, that's a fair question. We are a little bit different from a bank in the sense that we don't have margins or fees or anything. So essentially, if you come to us and say, look, I pay 8% in Colombian pesos, how much you pay back in dollar, we're not squeezing in 2% like a bank would do. We are, how do you say? Yeah, we are a little bit of a weird animal, if you pass me the expression. But there is no like fees connected to the service. It's simply the price that we pay. And that ends there. So there is no, essentially, there is not like a fee to pay. The next question is essentially how TCX makes money. And the answer is that we don't always make money. We lose it quite often and we make other time. Essentially, our sustainability depends on the interest rate differential. So you think that you pay 8% in Colombian pesos and we pay you 5% in dollar, there's a 3% difference. And essentially the currency does not depreciate more than the 3%. We end up making a gain. Put it like as simple as I can put it. Yeah, so to answer the question, yeah, there are not really fees or margin that we take within the deal to compensate ourselves. We're not a bank.
Perfect. Jonas, thank you so much. Now I would like to open now the conversation to Robert and Camila. Thank you so much also for joining us today with more experiences, bringing this kind of information, which sounds a little bit complicated and technical, but let's try to digest all this information with more examples. So Robert, I would like to well, first of all, welcome you here and thank you for sharing with us your experience. And why don't you tell us a bit more about FMO, the Dutch Development Bank, and why FMO was behind TCX creation?
Well, we go a long way back indeed with TCX, but let me first start. So FMO indeed is the Dutch Development Bank. We operate globally in developing countries and emerging markets, and also in Latin America, where we have been active for a long time. Our total committed portfolio is roughly 12 billion euros, out of which 1.7, so a bit less than 2 billion, is invested or lent in Latin America. Green is actually a focus sector, so green finance, and then in particular renewable energy is something which we do a lot and really focus on. So roughly 4 billion out of the 12 committed is committed to green finance, and a large part of that is renewable energy, but it can also be let's say green credit lines to local banks, sustainable agriculture, and forestry. Then the local currency aspect, yes, we like to see ourselves as a preferred partner to basically to invest in local prosperity, and one way to achieve that is to help end clients also manage their risks. And traditionally, very often, let's say financing was always done in hard currency, mostly in dollars, especially in Latin America. While the entrepreneurs or the companies that we finance actually earn money in local currency. So there's a mismatch, and Jonas already explained that. But that was the key interest that we had also to support the creation of TCX back in 2007. And we have been making use of it considerably, I would say. So we are one of the let's say clients of TCX. We use TCX a lot, but also when possible, we use let's say other commercial parties. So there's a mix of FX hedge providers that we use. I already mentioned renewable energy. So in terms of technologies, wind and solar are the fastest growing technologies in our portfolio, and our portfolio is roughly 600 million in Latin America, which then stretches from Argentina up to Peru, Central America, and to the Caribbean. And then maybe in terms of countries and eligibility, we work basically in all countries, but we do focus on the countries where, let's say, our financial additionality is highest. So in other words, where there's not so much liquidity in the market, or not enough to finance all the good and nice green energy projects that are being developed. And that's why we are not active anymore in markets such as Mexico, Brazil, and Chile. Back to you, Carolina.
Okay, thank you, Robert. No, and thanks for elaborating on your presence in Latin America. I think a lot of people will be interested in reaching out to you now that you're mentioning those countries. But now I would like to move to Camila. Thank you for being with us. Could you please give us some context on the local situation in Brazil for financing renewable energy projects, and of course the role of CELA and AppSolar?
Sure, thank you. Good morning and good afternoon to everyone, and thank you for the invitation. Just like to make a comment, I'm not CEO of AB Solar, the Brazilian PV Association. I'm a board member and vice president of finance. We do have an executive president there, but I'm a member and a board member. And then I am managing director and CEO of CELA Clean Energy Latin America, which is a financial advisory firm that works with renewable energy companies in Latin America, but mostly focused in Brazil recently.
Thanks for the clarification, Camila, and apologies.
Thank you. So here in the solar sector, talking specifically about the solar sector, as I'm representing AB Solar as well, We reached this week a very important milestone of 9 gigawatts of installed capacity. So we're celebrating here this week this achievement. We still represent just under 2% of the Brazilian electricity matrix in terms of installed capacity, but growing very, very fast. Of these 9 gigawatts of installed capacity, around 60% of it is distributed generation, which grows quickly, very, very quickly here in Brazil. And the remaining around 40% is utility scale projects. In terms of investments, this represents, since 2012, which was the beginning of the solar industry here in Brazil, we've had around 50 billion reais of investment in the sector and growing every year. Around 264,000 jobs created in the sector, and around 10 million tons of CO2 emissions avoided. In terms of financing, what you asked me specifically, in 2020 alone, I managed to track around just over 7.5 billion reais in investments in the sector. So calling like each one of the banks and financial institutions. So there should be more, but the ones that we managed to track down. And of that, I would say around $200 million that I managed to find that were in FX. Okay, so Brazil is very much predominantly local currency financing because mostly in the sector used to be very much focused in the utility scale projects, PPAs in Brazilian currency in reais, and in distributed generation, the PPAs are in reais as well. We've been seeing a diversification away from local development bank financing, which used to dominate, I would say, over 90% of all renewables financing here in Brazil. And because of the changing role of the development banks, we're seeing a diversification to a market solution for financing with increasingly, like we saw the first wave was through bonds, project bonds. For utility scale projects, we have those incentivized bonds, the debêntures incentivadas. And then last year, we even had a government incentivizing for these bonds to be green bonds. But we're also seeing like new options, right? Because we are diversifying also away from the regulated market to the free market. And in the free market, you have options to have PPAs in other currencies other than Brazilian. This is very new in Brazil. I've seen like a couple of announcements of big projects that had those PPAs in US dollars and the other one in euro, and this opens the door for FX financing, and this is all very exciting, and this is all linked to this migration to the free market. It's all linked to the growth of the sector, and you're seeing that the growth of investment required and financing required cannot be fulfilled 100% by these local development banks. So this is becoming and will become even more of an issue, and this solution for FX hedging is definitely something that will attract attention. Especially what I heard with a lot of excitement is the term, right? Being very long term. This has been very much of the issue, like the term of the hedging available, and also the cost compared to the local currency financing. So this seems to be like something that could be very, very, very interesting for the sector, and for solar, where the capex is in US dollars or in euro, for example, it's not in local currency. Most of it, I would say like 70-80% of it is not in local currency. Then it makes a lot of sense.
Good news. Because at the same time, and I think you mentioned two important things here. First, it was more development banks, my understanding, and then they work there, helping to develop that market, then moving away, and then letting other investors getting into this market. And now with this free market, it's very important. And this is why for instance, probably Robert mentioned, we are not longer in Brazil. I mean, we now need to move to other markets. So makes total sense. And now you have also different parties having different FX risks. So TCX will be a perfect opportunity for these newcomers into the market. Robert, please feel free if you have any reactions also to what Camilo mentioned, but I wanted to ask you if you can share with us how you see FX hedging as a solution for financing renewable energy projects in emerging markets, and if you could give us an example so we can understand how it worked in the past. And you are on mute.
Apologies. Sure, I will. I will also give an example. Yeah, so Camila also touched upon an interesting concept, which basically is related to my answer. To what extent local currency finance can help sort of further renewable energy projects in many countries, also still in Latin America. Actually, the power purchase agreements are denominated in dollar, or they follow dollar. So then it doesn't. If that's the case, then the local currency finance is not relevant. So it's mostly relevant for countries that do issue PPAs in local currency. An example there, for example, is Colombia. They had recently these an auction round for renewables, wind and solar, and the PPA is standardized and it's all denominated in pesos. So there, in order to come into play and to enter the market, you really need to bring offers in local currency. And there, actually, we also have been working a bit with TCX in the run-up to that and to become active in Colombia in the energy space. Another sort of part of the energy sector is are the distribution companies, because they basically they carry the risk of currency depreciation or appreciation versus the dollar. Because they on the buy side they may have PPAs in dollars, and then on the sell side they generate local currency. So especially on the distribution companies, the discos, I do see let's say opportunities for local currency financing and for cooperation with TCX. Another very relevant sector, and Camilla mentioned it, is the distributed generation sector, and or the off-grid energy sector, because there you do not have, let's say, those standardized PPAs, and there's a more direct link to the end user, there is a strong need to finance those companies in local currency. As one example is an off-grid company in Central America offering energy solutions, basic energy solutions to households on a lease or rental basis in areas where there's actually very poor electrification, so there's no access to the electricity grid for these households. And then, let's say, a household solution off-grid is the only solution for now. And for that company, we've structured 15 million local currency financing. And there, in order to sort of match the currency risk, or at least not unload the currency risk to the supplier, who is our client. And that was structured for, I think it was 8 or 9 years, so it's also long term, and that's exactly also the let's say an advantage of TCX, is that they indeed can offer long terms, because many of these projects in energy, they need it's very capital intensive, so you need to also match the maturities of the financing to the maturities of the assets, and that requires long term financing.
Thanks, Robert. And then I would like to highlight on the long-term part and ask you, Camilla, now that you also mentioned that you were happy to hear this from Jonas, And so considering that TCX provides solutions to manage currency risk for long-term financing, do you think the solutions could facilitate financing for these projects, especially from international investors, and how with this new dynamic on free markets in Brazil?
Yes, definitely, because Brazil is a very large market for foreign investors, but for foreign investors that already have large operations in Brazil. So investors that are already here, they have operations in local currency, they are comfortable with it, they've been here in Brazil for many years. So for new, especially I would say for new players that are foreign investors that are not or have not been here, don't have operations here, I think it's definitely even more relevant.
Super. Now, I would like to direct this question to Jonas, but if you also can complement maybe Robert, or if Camila, you have had this experience. We have a question here. It says, when is the right time to establish a connection with TCX to start a FX operation analysis or FX hedging solution? So what's the right moment? They are asking before, during, or after issuing a bond or loan. When is the right time?
Well, as you might know, if you want to trade derivatives in the world, not only with the TCX but with any commercial bank, you need to sign what is called an ISDA contract. It's an International Swap Derivative Association contract. It's a standardized legal framework to trade derivatives. So to sign that document is not something that is done overnight. So it goes through a little bit of negotiation. There are lawyers involved, and I hope there are no lawyers in the call, but or maybe there are. Like, it always takes time when you have someone looking at the legal. So if an investor has realistically a pipeline or is really considering to go into this market, he expects to trade multiple deals over time, you can approach TCX. I think my email is somewhere. I will share it at the end, and we can see whether it's possible. The ISDA contract is a general framework. You sign once, and then you can trade not as much as you want, but you can trade freely. Let's put it that way. So it is important to establish the connection a few months ahead of a trade, because, yeah, as I mentioned, it takes time to put together all the legal paperwork before being able to trade. And by the way, this is the same if you trade with TCX or if you trade with any commercial bank in the world. The standard is exactly the same, and the document is pretty much the same as well.
Understood. Okay, thank you, Jonas. I don't know, Robert, if you have something to add there in terms of your experience. Did you reach out to TCX during the process of investing, before, after?
Yeah, before or in the process of when you're still sort of analyzing the opportunity. Yes, we have regular contact also with TCX, with Jonas and the team. But we also have an in-house local currency knowledge center that basically is our first point of call. Yeah, we sort of onboard the local currency financing options during also our internal approval process. So indeed, let's say an early stage or fairly early stage reach out is I think is suited.
I would actually suggest just to get in touch with TCX and explore. If you haven't done this before, just I think establishing that relationship for those of you that are interested, I think it will be good, a good idea.
Especially because we can also share pricing. We can also share like which solution are available before engaging into a heavy legal work. First, we need to prove on both sides that there is a business case and they really make sense for the investor, the issuer, the client, and all the parties involved. Doing local currency is a little bit more challenging than doing dollars, dollar financing, although it's, it gets more fun and it's, I think, a little bit more rewarding at the end of the day. It's a more complicated product, but it's the right one in many cases.
Okay, fantastic, Jonas. Camila, I wanted to ask you, now that there are more opportunities for different investors, there is more diversification. Well, definitely there are opportunities to attract more international investors. But what type of investors are you looking for? And is it, when we talk about internationals, you're talking about Europeans from the US or even from the region? What are those investors that you're looking for?
Here in Brazil, what we have is a lot of strategic investors from several countries, like we have from North America, from Europe, and from Asia, that are very, very active here in the solar sector in Brazil, both utility scale and distributed generation. In utility scale, it's more concentrated on the big strategic players. It used to be mostly because the PPAs were in the regulated market, and there are auctions, like reverse auctions, very competitive. So the cost of capital was something that always made a huge difference. But now with the opening of the free market, then there are more opportunities for diversification in terms of investors. And in distributed generation, I would say like this is a very booming market, and with many new players being created every day. I mean, I guess there's like over 20,000 companies acting in distributed generation in the country today, and growing. With different business models as well, like companies that focus on like selling equipment, others focused on installing and selling and installing equipment, and others focused even on business models of leases, whereby the final consumer doesn't have to make an investment. And this I think this third business model is the one that has been attracting investors that are like more sophisticated in terms of financing and of strategy as well, and that maybe have had experiences in distributed generation in other regions as well.
Fantastic, thank you. Now we are getting close to the end of the webinar. I have, Robert, another question for you. Now that you are in Europe and you kind of have that sense of what the European investor wants, what do you think is the appetite here for the region? And you know, what do you think would be kind of the risks that they are thinking when they come to Latin America, and if this is definitely something that they perceive as one of the main risks, like the FX risk?
Yeah, well, I mean, I think it's a minute is too short to really answer it, but I'll try. So first of all, there are really excellent renewable energy projects. In Latin America, being developed and or already operational. So in terms of the asset itself and the resource potential, I think that's a good one. So that's a plus. Then some countries may be characterized by slightly higher or substantially higher political risk compared to most of the European countries. So that's a risk factor. And then the other factor, which is maybe slightly related, is the currency risk. I think that is the one that at least today we discussed, and which is a type of risk that can be mitigated by hedging. So I think that already sort of creates for a far better sort of risk perception and acceptance or acceptability also for many European investors. So I really think that will help a lot to get them sort of investing across the ocean.
Thank you so much. Well, it's already the time to say goodbye. So thank you very much for being with us, for sharing all this information. I think it's very important for the audience to understand the concept, understand the practicality of this product. So thank you, Camila, Robert, and Jonas for joining us here today. Jonas, if or Camila, Robert, if the audience wants to get in touch with you, what do you think would be the best way to do so?
If they should have they should have your email or someone in your team, maybe. If you can reroute the request, or you can also distribute personally my email. You can send it around. There is no problem.
Okay.
I think it's even on our website, or they can also check on LinkedIn. You can text me on LinkedIn.
LinkedIn. Okay, perfect. Robert, any specific channel, social media to follow you?
No, I think rerouting the request or sharing my email address is fine. Yeah.
Perfect. Camila?
Yes, please, if you could concentrate the emails and then reroute to us. There is an AB Solar email I'll share with you that the best channel to reach the association.
Perfect. So thank you very much to all for joining us. The recording will be available on YouTube. Have a wonderful day. Goodbye.
Thank you.
Bye-bye.
Thank you. Goodbye.